So, good afternoon, everyone. My name is Maurya Hanspal, and in this session, we will continue our previous sessions on investment banking. And this is the session number 5 to which I remember. And in this session, we're gonna talk about some of the methods or some of the tools of valuation. Okay, and these are some kind of approaches that we tend to use in the concept of valuations. And the top investment banking companies and investment bankers are using these tools of valuation. Okay, so there are majorly when we talk about the different approaches of the valuation techniques and the valuation, we basically talk about the three approaches. The first approach that we talk about is your income approach. The second approach that we talk about is the comparable approach, the company's comparable approach. The company's comparable approach is also called your relative valuation approach. And the third approach that we talk about is the asset based valuation approach. So these three approaches are one of the most important approaches, or three of the most important approaches, I would say, into the field of finance or the tools which are used popularly by the investment bankers. So first of all, in this session, I'll start with the first approach and try to finish all the approaches within this 30-minute session. Or if these approaches are not covered in this session, I'll be covering these approaches in the subsequent sessions. Okay. So talking about the first approach that we talk about is your income approach. And it is the most widely used approach, income approach, even when you prepare the financial model of a company. By financial modeling, I mean when you are doing the forecasting of the company, or when you are predicting the future cash flows, the future profitability of the company, incomes, and all those stuff. This method is most popularly used, the income approach. You might not know this approach by the main heading, but you would certainly know this approach by the subheadings, right? Because this approach is taught into all the institutions of finance, be it you are doing your BBA or BCom or MBA. This approach is taught to you in the valuation techniques or in the financial management curriculum. This approach is one of the most important approach used by financial analysts, investment banker, and various other financial experts to value the company as well. Within this income approach, which is of course the main heading, we have the two more sub approaches or subheadings that we call under the main heading. The first approach, which everyone has heard about, is your DCF analysis. DCF analysis. So when we talk about your DCF analysis, it's your discounted cash flow analysis. It's called your discounted cash flow analysis. A large number of the finance students or finance enthusiasts might know about this approach already, because this is one of the first approaches which is taught to students in BCom, BBA, in MBA, or any other courses of finance. Because until and unless you do not know the DCF analysis or the discounted cash flow analysis, you cannot go further in estimating the value of the company. So what do we mean by the discounted cash flow analysis, and how is the discounted cash flow analysis used in the real world scenarios? So basically, as the name suggests, discounted cash flows. It means we are discounting some cash flows, right? And why the cash flows are discounted? To calculate the present value of your stock or your company. Basically, to know the intrinsic value. And what do we mean by the intrinsic value? By intrinsic value, we mean the most basic fundamental value on which everyone would agree upon. A basic value in which all the analysts, because when we talk about the different approaches to valuation, we talk about the income approach, we talk about the market approach, we talk about the investment value approach, right? So basically the three approaches that we talk about: intrinsic value approach, which is ultimately derived from your income approach, then talking about the market approach, which we'll do in the subsequent model, and the third approach, which people talk about, is your investment approach. Investment approach is basically used for the purpose of mergers, acquisitions, takeovers, and amalgamations, and all those stuffs. Okay, so intrinsic value is something on which everyone would agree upon, because every analyst has a different method or methodology to value the company. He might use some different tools, some different techniques, some different multiples, some different ratios. Also, his approach to value the company and look at the company might be different. And that is why his personal perspective and sometimes behavioral finances or behavioral biases also come into place while valuing the company. Like, for example, you might have witnessed this fact that why do all the IPOs or the initial public offerings of the company come at the time when the market is at a high pace or when the market is booming or the share market is rising? Because everyone know at that point of time a large number of stocks or the stocks of the companies of like basically shares of the company would be at a very high value, even for those companies which have no fundamentals, no cash flows, no profitability, and no future projection as well. Even the prices of those companies would be high because of that irrational exuberance. By irrational exuberance, I mean people are buying the stocks without seeing any fundamentals, just because everything is rising in the market and people are buying that stocks, and you also like start buying that stock like on the basis of the irrational exuberance or herd mentality. Okay, and that is why a large number of the IPOs come at this time. Okay, because they want to take a larger amount of money from the public and they can charge huge valuations about that. Okay, huge valuation can be charged at this point of time, because ultimately when the market is at a boom and people are willing to buy everything, and tech companies are also on a boom, so be it the loss making platform companies as we popularly call them as Paytm, Zomato, Swiggy and all those companies, or be it any other tech company, even if those companies are at a discounted level or being having no cash flows and no profitabilities and no future projection as well. I'm not saying that Zomato, Paytm have no future projection. They have a good future. I'm just talking in general. Okay. So just talking about, so these companies can command a higher valuation in the market. And why these companies can command a higher valuation in the market? Because everything is on a rise. Even if the companies have no fundamentals, they can command a higher valuations. Why? Just let's take a simple example. As a seller, you would want the highest price from your buyer, right? As a seller, you would want the highest price from the buyer. Where are your initial public offerings raised or come up in the market? When IPOs come in the primary market and not in the secondary market. So now the question arises, what is the difference between the primary market and the secondary market? So to like summarize the differences in just one line, the primary market is something where the shares get listed for the first time. Your initial public offerings or the IPOs, they come into the market for the first time in the primary market. And when we talk about the secondary market, your shares are bought and sold in the secondary market, basically. Okay, so why? So basically, a large number of allegations have also been put on these companies. And I repeat this fact, allegations. Okay, because in the primary market, when the shares come for the first time and the people submit their applications for the IPOs, the first time the money goes to the company only in the primary market. In the secondary market, the money, it does not go to the company. The shares are bought and sold like within the buyers and sellers. Okay, but in the first time, the IPOs are raised in the primary market. The money goes to the company only. At that time, the company, in consultation with various investment bankers and various financial analysts and management, can command a premium for their company. Because ultimately अगर एक बारी प्राइस मिल गया कंपनी को, the company has fulfilled its objectives, and like in the second scenario, the prices have to be traded or shares have to be traded with like within the secondary population only. So that is the first logic which people look into consideration. Also, when people are putting their money in the initial public offerings, they are withdrawing or redeeming their money from the strong companies or fundamentally strong companies. Because as a layman investor or as a retail individual investor, I'm talking about. Because I'm talking about those middle class and upper middle class people who do not have excess cash with them, to either change their investments, that is, withdrawing their investments from like one stock and putting their money into these new IPOs. And that also brings a correction into the strong companies as well. So this thing must be taken into consideration by the retail individual investors who do not invest into the market for an amount of more than 2 lakh rupees. Whereas a person who's a high net worth individual or ultra net worth individual, that person has no problem. That person's money would be there in the stocks that in like the main portfolio which he already has. Also, he'll be like putting more money like in the IPOs. So basically, that doesn't make a difference. Okay. So this thing must be taken into consideration while talking about the IPOs. So this method of discounted cash flow is basically used to calculate the intrinsic value of the stock, or in further scenarios, the enterprise value of the company. Okay, but in this scenario, we'll be trying to know how this discounted cash flow analysis works or the DCF analysis works. So what are we doing in the discounted cash flow analysis? First of all, we have the cash flows of the company. That is the present cash flows of the company. Like for example, if we are in the year of 2022, we have some cash flows till date. That is still like 2022. Like we have the cash flows till date. So we'll be seeing the cash flows of the past years, like maybe past 5 years or past 10 years. Like we can take this year like 2022, then 21, 20, 19, 18. So from 2018 to like 2020, we can see the cash flows of the company. Okay, or maybe like from 2017 to 2021, because yet the financial year is yet to end. Okay, so basically from 2017 to 2021, we can take the cash flows, and on the basis of the past 5 years cash flows, we can predict the future cash flows. Okay, then how to predict the future cash flows? Again, we have like two types of models of free cash flow to firm and free cash flow to equity. So that we're going to talk about in some other sessions on the valuation approaches. Okay, but as for now, like just for the sake of simplicity, just take into consideration that we are trying to project the future cash flows now. We have the past cash flows and we're trying to project the future cash flows with that. Now, how do we project the future cash flows with that? That's again a separate topic, like which involves your FCFF and FCFE work, and also that we'll talk about in one cover session, like where I'll be teaching you to prepare the financial model on Excel, and we'll be doing and calculating the future cash flows of the firm and then discounting them to calculate the enterprise value. But as for now, for the sake of simplicity, because everyone is joined here in this session, be it your BBA students or BCom students, they might not have a clear understanding about the free cash flow to equity or free cash flow to firm and how do we calculate the enterprise value. So just for the sake of simplicity, I'm just saying this. Just take into consideration the previous 10 years or 5 years cash flows, and then on the basis of that cash flows, try to project the future cash flows. And how to project the future cash flows in a basic sense, and that you can see कि past year में cash flows कितने बढ़ रहे हैं. अगर बढ़ रहे हैं तो क्यों बढ़ रहे हैं? Why the cash flows are increasing as compared like to the previous year? And the reasons you have to find out, and on the basis of that growth rate, you can predict the future cash flows as well. Like if the cash flows are rising in a good trend or an increasing trend, in that way you can predict the future cash flows as well. Okay, that is the basic scenario like that we take into consideration. But otherwise, we do our calculations starting from your EBIT, and then we make some adjustments and all and calculated the future cash flows. So that we'll do in a subsequent session, in a separate session for financial modeling. Okay, so do not worry for that. Okay, so coming back to the session, अब जब हम बात कर रहे हैं DCF analysis की, अब just assume the future cash flows have been projected. Okay, you have the future cash flows with you right now. So I'll just show a PPT to you. Yeah. So just assume the future cash flows have been like projected to you. Okay, like you have the future cash flows, and these are ultimately your future cash flows only. Like for example, like presently in 2021, we are in the year zero. Assume that we are in the year zero. Okay. Year one will be 2022. Year two will be 2023. Okay. Year three will be 2024. Year four will be 2025, and year five will be 2026. So these are not the present cash flows. These are the future cash flows. Just do not confuse yourself. People say that we can get the cash flows from the cash flow statement and we can take the past cash flows and then we can discount it. No, that's wrong. You can take the past cash flows, but you have to predict the future cash flows. And the future cash flows are only discounted. Now you might be worrying that I'm repeating this word of discounting, and what do you mean? What do I mean by discounting? So certainly these are your future values, your 5,000, 6,000, 8,000, 7,000, 4,000. And we want to know the present value of these future values, because ये तो चलो a future की बात हो गई. And coming back, like why are we calculating the future values? We are calculating the future values because ultimately, if we are listing our company on the stock exchanges, or if we want to prove that our company is good, presently the company might not be generating cash flows, but if we want to prove our investors, the investment bankers, the analysts, to the main public or to the people who basically would be investing into your corporation, you have to at least project the future cash flows, because ultimately future cash flows के basis पे ही तो वो आपकी company को खरीदेंगे. You cannot just randomly frame a price कि my company like is worth rupees 4 billion, my company like is worth rupees 2 billion, the share price of my company should be like 5,000 rupees and all. You cannot do it blindly. All these valuation techniques are used for that, for the purpose of financial modeling. So similarly, you'll have to project the future cash flows. The investors or the people who want to invest into this company will see that are these future cash flows justified or not. Because again, the future cash flows cannot be like predicted or cannot be forecasted on a random basis. Like for example, if I think that my cash flows had been like 1,000, 2,000, 3,000, 4,000 in the year of 2021, I cannot say that like it would be 5,000, 6,000, 8,000. I have to bring justification for that. I have to show that currently I might be making some capital expenditures, and because of that, my cash flows are less or my cash flows are negative, right? So basically, when the cash flows are negative, again, the DCF method cannot be used because the DCF method can be used only for the positive cash flows. But how the DCF method can be used for the negative cash flows also? If a company can predict positive cash flows in future. Like maybe to the year of 2021, the cash flows for my company is minus 4,000 rupees. So I cannot use DCF. But if this minus 4,000 can transform into at least 0,000, 2,000, 3,000, 4,000, I can discount that future values to the present value and calculate the enterprise value of my company or the present value of my company. Basically, the enterprise value, like we'll talk about in some subsequent session, but at least the present value of my company. So take into consideration if the company is predicting negative future cash flows for the next subsequent years, you cannot use a DCF analysis. But if those negative cash flows can be transformed to the positive cash flows in future, then you can predict the present value of the company. And company की present value आपको predict करनी ही पड़ेगी until and unless you do not predict the present value, you cannot command the share price for that company, right? Now coming back to discounting. So here we calculated the future values. Now what exactly is discounting? So ultimately, see, if we are trying to project the future, it basically involves compounding. Like basically, if we want to know that if we had invested certain amount on that present day and how much this amount was worth after 5 years from now or 10 years from now or 20 years from now, in that case we can use compounding. But if we have that future value with us already, today's 5 years value we have already, and we want to know that what would be the value today. In that case, we call it as discounting. Okay. So the same rate which was used for compounding, compounding is a phenomena which is very well used in stock market. कि आपका पैसा कैसा बढ़ता है market में. So similarly, the same rate of compounding will be used as discounting. If you want to know the present value of the future value. So now these 5,000 rupees, 6,000 rupees, 8,000 rupees, 7,000 rupees, 4,000 rupees are the future values. And you want to know the present value of these values. So how are you going to do it? You're going to discount these values. And the formula for discounting is your future value FV. I'll just write it down in a better way. Let's draw it. Yeah. Is your future value divided by 1 plus R. R is the discount rate to the power of N. N is the time period. So first year के लिए N तो होगा 1. For second year 2, third year 3, fourth year 4, and fifth year 5, and so on. Right? 8% is the discount rate. This 1 plus R is the discount rate. So what is this discount rate and how do we calculate this discount rate? So when we calculate this discount rate, it is nothing but your weighted average cost of capital. When we calculate your discount rate, is nothing but your weighted average cost of capital or WACC. Now what exactly it is? It is nothing but the minimum return which all the capital providers are expecting from your company. Okay? The minimum return which all the capital providers are expecting from your company. Now, give me a second. Yeah. The minimum return basically, like for example, as an equity investor, I invested into the shares of that company, so I want a certain return on that. Okay. Similarly, some debt holders might have provided loan to the company and they want a certain return in the form of the interest on them. Okay, so these scenarios are possible. So like when we talk about the weighted average cost of capital, like then you have the huge calculation, like calculating the cost of debt, you have the cost of capital and the cost of equity. So all these scenarios are there. Okay. So these things are something that take into place as well. Okay. But for the sake of simplicity, if you want to know again that how to calculate the cost of capital and weighted average cost and all that, we have done it in the financial management sessions in very detail. All the CAPI models and all that stuff. But for the sake of simplicity, for all of those who still have no understanding that what exactly is WACC, WACC is nothing but the minimum return which all the capital providers are expecting from their investments. इक्विटी शेयर होल्डर है उसको भी कुछ रिटर्न चाहिए. The debt holder provides certain interest payment on that. So all the capital providers want some interest payment. Okay. And this WACC will rise by when the firm becomes more risky or when there is more uncertainty in the market about the future returns. But when there is certainty in the market about the future returns and the firm is less risky, in that case, the WACC would be lower. So one thing is quite clear. Agar ye WACC ka amount, which is nothing but your interest rate, or we also call it as a discounted rate. If this rate is higher, obviously your future cash flows would be discounted at a higher level. Agar the rate of interest, agar denominator would be more, as more and more the denominator starts to increase, the value of the cash flows, the present value of the cash flows like will reduce, right? And if your discount rate is smaller, then the present value of the cash flows would be larger. Just try to correlate this concept with the interest rate rises. The US Fed announces to increase the yields. And due to that, a large number of the growth stocks or tech companies and other companies, their value reduces or their share price falls. Why? Because discount rate is nothing but it also includes an aspect of the government rate, the risk-free rate. It's an important component in determining the discount rate. The risk-free rate, it does not mean the total RF. Your interest rate or discount rate, it does not mean the total risk-free rate, right? It has a component in that. It has some smaller component in that, right? So, this component, it also determines your cash flows as well. Okay, again, this component, it also determines your cash flows as well. And it creates a lower valuation for the company. Okay, a lower valuation for the company. So that is a scenario like why these companies like start to correct also. Okay. So when they're talking about these valuations, companies key, थोड़ी बहुत like the start to correct. Give me a second. I think like there has been some network glitch. Has been some network glitch. Just a second. Network glitch. Yeah, there was some network connectivity back going on. Okay. Yeah. Okay. So this WACC, like whenever we are calculating this WACC, basically the weighted average cost of capital, this risk-free rate now it has an important component here. Okay. This is not the total RF, but it has an important component. So when this value rises, again your cash flows will be discounted at a higher level. And when your cash flows will be discounted at a higher level, it can create a further problem with the cash flows ultimately. Right? The cash flows will be discounted at a higher level. The cash flows की value भी कम होगी. Okay. So that scenario like you can relate with that. अब ये value हमारे पास आ गई है. इसको हमने like discount करा. We have 5,000 future cash flows. 6,000 future cash flows, 8,000 future cash flows, 7,000 future cash flows, 4,000 future cash flows. You tend to like discount it with this rate, with this rate, with this rate, with this rate, with this rate. Okay. When you started to discount it, like you got the value of like 1.08, then 1.17, 1.26, 1.36, 1.47. And once you divided 5,000 by 1.08, 5,000 by 1.17, yeah, 5,000 by 1.26, 5,000 by 1.36, and 5,000 by 1.47, you got these values. 4630, 5144, 6351, 5145, and 2722, and जब हमने इन values को add करा, we got 23992, 23992, and so that when you added all these values. So now the question arises, like this is the sum of your present values. So ultimately, like just assume like you had put an investment of 20,000 into these stocks. ये company A है, ठीक है? And we predicted or forecasted the future cash flows of this company in year 1, year 2, year 3, year 4, and year 5. An investment we had done in this company was 20,000 rupees, and this is the present value that we're gonna get. So ultimately, what's your NPV? 23,992, like which you got at the end, which you are expecting at the end, minus 2,000 was your investment. It means positive 3,992 का return हमको मिलेगा. 3,992 का रिटर्न मिलेगा. और इसे अगर हम परसेंटेज में करें 23,992 माइनस 20,000 डिवाइड बाय 20,000, 19% का रिटर्न. इट्स अ गुड रिटर्न. Like over the year, like you are getting a return of 19%. स्टॉक मार्केट या एवरेज में like 13% का रिटर्न देती है, like 13 to 15% का. ठीक है. So again, you have to see that the present value that you are getting, or ultimately the value that you are getting from your investment, it must exceed your investment. अगर ये value होती like 18,000 rupees, so obviously in that case like you are losing 2,000 rupees. So with 20,000 rupees you have not invested, you are planning to invest, and that is why you forecasted the company's future cash flows and then discounted it, and then you thought, in case if I had invested the 20,000 amount, then what approximate amount I can gain from my investment. What approximate amount I can gain from my investment. Ultimately, you got to know about that. तो मैं लग रहा है कि अगर मैं 20,000 rupees if I like invest in market, I can get a return of like 3,992 rupees at least. इतना return मुझे market से मिल जाए. ठीक है? That's your discount. And this DCF analysis can be used like in terms of your machinery, like if you're like purchasing machinery and comparing two machineries or two projects. The machinery or a project which has a positive net present value is always accepted. You can compare two stocks, even two machineries, two items, kuch bhi, and the cash flow or the net present value jahan ka positive aaye, it means you have to accept that project or you have to buy that company. So this comparison is done between companies, and that you need to know, and this comparison is very important. Okay, so always do this comparison like between two projects or two companies or whatsoever as you are doing. And always accept a project with a positive NPV and reject a project with a negative NPV. Okay, that's all.